On the podcast with us today is Hayden Harrington. Hayden, welcome to the podcast.
Thanks for having me, Dan.
Well, Hayden, I want you to, before we get started talking about this acquisition that you had recently called the Henry at Liberty Hills, located in Houston, Texas, 228 units. Before we dive into that acquisition, I want you to first tell us a little bit about yourself and your background and where you are right now as far as the multifamily side of things is concerned.
Yeah, absolutely. And first of all, just appreciate you having me on the show. Big fan of all the content you put out. So really honored to be here. Yeah, like you said, my name is Hayden Harrington. I'm 26 years old, based in Dallas, Texas. Got my start in real estate in general growing up. I did fix and flips and had some rentals with my dad. Lots of, how to rehab a property and stuff like that. But it also showed me the risks when you go small, because we had, tenants that would just get up in the middle of the night and leave. We had people that would steal appliances from us. And so, a lot of people think that's where you have to start because that's what they can afford, but there's actually a lot of risks involved with starting small. And so that's where the appeal for real estate really came from. Out of college, started a nutrition company, actually. That's kind of where I got my marketing and branding background because, well, frankly, I couldn't afford to pay a designer, so I had to figure it out myself. But, ended up growing that company to having being in 90 stores across the Southeast. And after I exited that, that's when I really dove into real estate because I've always had that bug and always had that dream to go bigger, but couldn't really figure out, how to get my foot in the door. So just started networking around, trying to figure out how the game is played and going to local networking events and stuff up here. And, I knew networking, your network is your net worth. And I knew that was kind of the key to the real estate game. And, I was more of an introvert. I wasn't that great at networking too. And I was going around to these networking events and I just noticed there's, there was a problem with the current networking events. They typically at restaurants and you'd sit down and you'd meet two people, the people sitting right next to you. And then you'd leave, and it was kind of disheartening because, I wasn't that great at networking, but, I knew that was the key to this business. And so, as I continued to try and network around, build my network, try to add value to people too, and get my foot in the door, because simultaneously I was out offering to some people. I was like, hey, I'll work for free. I just want to be around people that are doing deals because I know, proximity is power, right? And a lot of those people actually turned me down. A lot of doors got closed, and that's when kind of I had that light bulb moment, and I said, well, am I really offering any tangible value to these guys? Because I knew in multifamily, a bank's not even going to lend to me if I don't have experience. So I knew, I needed a partner. I needed somebody to kind of take me on and help guide me along the way. But what I was offering was an actual tangible value. And it took me a long time to realize that. And that's the first thing that most people think about too is, I'll just offer my time, right? But to somebody experienced, is that really something they want? And so I had to rethink what value was to be able to really get started. And I knew just from networking around, starting to learn how the game is played, that, true value is deals and capital. If you can bring one of those, you're bringing true tangible value. And I knew bringing a deal would be tough because, what broker is going to give somebody they've never heard of a sweet deal? It's just not going to happen, right? And so that's why I landed on the capital. And so, I going around to different local networking events and stuff like that, I realized that this is, these are the pools that syndicators are pulling equity from. And I just asked the question, can I do this better? And so I had, brought the idea up to my now current partner, Dustin Miles, who was an experienced syndicator. He'd done 10 syndications previously. And he said, let's try it. So we teamed up, we started a networking event together up here in Dallas, and it grew to a pretty big ordeal and ended up turning into a partnership. And now all this time later, we finally got a deal closed and we're looking for more.
That's exciting. That's really kind of, cool to kind of see your transition from basically doing nothing to getting that partnership and then eventually getting this deal closed. So let's go ahead and start talking about this deal a little bit. This is called the Henry at Liberty Hills in Houston, Texas, 228 units. Tell me a little bit about first how you actually sourced and found this deal.
Yeah, so it was on market. We bought it through Berkadia. You know, most of the deals we look at are through all the brokers. You know, they pretty much control the market, whether it's on market or off market. It's pretty much done through a broker. So we had started to develop relationships with people down there in Houston. I'm from Houston originally, but you know, obviously I had never done a deal down there, and Dustin hadn't either, because most of his stuff was up around DFW. And so it took a little bit to kind of crack into the market, but we had been simultaneously building a relationship with Asset Living, which is one of the larger third-party management companies in the country, and they're based right there in Houston. So they actually had a lot of great relationships with brokers down there too, which really helped us actually win the deal, which was surprising, because their VP of business development was really tied into some of the brokers. And so you know, he was kind of vouching on our behalf for us with the brokers. And I think that actually helped us, you know, get invest in final and actually win the deal eventually. So I think that was really huge. And at the same time, you know, in late 2020, you know, mid 2020, deal flow kind of dried up for a long time. And then the fourth quarter of 2020, the floodgates just opened up, and there were so many deals out. And I think that helped kind of spread the competition out. So there wasn't a ton of people actually looking at this deal. I think there was only, you know, 7 to 10 offers. And, you know, we came in, you know, there was multiple rounds too. And then we ended up winning the deal because we had the best terms. We didn't necessarily have the highest price, but, you know, they had a loan coming due, and we knew that. And so, you know, terms spoke the loudest, and that's kind of what enabled us to win the deal.
So this one came through the broker. How soon after getting it through, I'm assuming via email, being it announced to you, how soon after that did you go and tour the property?
It was probably, you know, 2 or 3 weeks. Actually, we don't just go and tour, you know, any property that comes out, because we do a pretty in-depth due diligence process before we schedule the tours, because we're very cognizant of, you know, and, you know, very aware of, you know, brokers' times, and we want to value that. And so we don't want to schedule tours with properties that, you know, we're not even close on, because we don't want to waste their time. So, you know, we do our initial underwriting, and, you know, we get pro forma from the management company. We get a tax quote, we get an insurance quote, we get our debt quote, and we kind of put everything together before we actually go and tour. Because if we're really far off, we don't want to waste the broker's time. We don't want to waste our time. So it did take a couple of weeks just to get all of our kind of ducks in a row. And then we actually toured the asset. We toured it with our management company, and we had our lender out there too. So we wanted to show them that, hey, we're serious about this, and we want the deal. So that's how we did that.
There's actually 2 schools of thought when it comes to quote unquote wasting a broker's time. Obviously, when you're first getting started, it's actually not a bad idea to still tour properties, even if you're not going to get them under contract or even go after them, because that's how you can build relationships with brokers. So there's just kind of 2 schools of thought there. And obviously, once you kind of get a track record and you kind of build that credibility already, and you don't need to be continuing to go out and tour properties, then yes, there's no sense in wasting your time as well as the broker's time just to go out there and, you know, rub shoulders on a property that, you know, you're not even going to go after to begin with.
Yeah, absolutely. Those are very valid points.
Yeah. So this being your first acquisition in Houston, you kind of leveraged the credibility of the asset or the property management company to be able to get the deal awarded to you. What was that like about when you had the conversation with the broker, and then again, eventually, you know, I'm assuming you probably went on a buyer call with the seller and, you know, had to kind of pitch yourself to them as well?
Yeah, it was an interesting experience, that's for sure. You know, thankfully, you know, we'd been building a relationship with Asset Living for a long time, so I was real close with them. Their VP actually played baseball with some guys that I played with growing up, so we had kind of some mutual friends, and that really helped cultivate that relationship. And so we were working on a lot of pro formas and stuff with them, looking at a lot of deals, and we really wanted to work with them. So I think that definitely helped. And they're a credible group, so I think that definitely helped us kind of get you know, have an advantage with the brokers. But it was, you know, an intimidating process, especially for the first time, because, you know, these are very sophisticated groups. You're talking big dollars. You know, the buyer seller interviews, Dustin definitely did more of the talking, but it was an incredible experience, that's for sure.
How many rounds of offers did you go through on this one?
There was the first initial round, the call for offer state, and then we did 2 best and finals. So there was a best and final and then a best and final. So it was a pretty drawn out process, actually.
So what was your initial offer on this one?
We came in pretty low. I think we're around, I want to say like 28.5. And they really wanted to hit 30, but we were still kind of concerned with the whole pandemic. There wasn't quite a light at the end of the tunnel, so we were pretty conservative on our numbers, and we just wanted to try and mitigate risk however we possibly could. But we worked with the management company. We went back and forth with them, say, hey, what can we likely expect? Because they do a conservative underwriting too, and that helped us kind of push our numbers a little bit. So the first round, we just wanted to get our offer in there. We just wanted to see what the landscape was. At the same time, too, we were in 4 best and finals at once, too. So, and all of the best and final days kind of landed around within a day or two, and so we were a little nervous because we were like, well, we'd like to get at least one, but 2 or 3 is going to start to add up, and we were talking $20-30 million deals. So. If they all hit, that would be, it'd be a good problem to have, but it'd be a challenge, that's for sure. So we were trying to balance, trying to figure out which one should we really pursue or not, because we wanted to see which one we were closest on, so that we could kind of pour our energy into those. And so, we lost out on a couple other ones, and it came down to 2. And it was the Henry and one other deal, and they were both very different. One was a value add, 1970 deal, and one was the Henry, which is 2012, a very stable cash flow deal. And we liked the Henry the best because we just liked, like I said, again, there was still some unknowns in the market. We didn't quite know when the light at the end of the tunnel was, and we felt that investors would be most comfortable with a cash flow, stabilized deal that performed well through COVID. And so that's kind of what we put all of our attention and our focus on.
What was the final offer on it that was accepted?
Yeah, we ended up getting it accepted at 29.3. So that was the final purchase price. So still shy of what they actually wanted, but our terms spoke the loudest. We had one extension. They allowed us to get one extension up to kind of their last day before they pretty much had to either refi or sell because their loan was coming due. And then we had a considerable amount of hard money. So that definitely helped us win the deal, because Houston was, it was about 50% of the deals at the time were having hard money on them. So you could get away with not having it, but obviously hard money, an assurance of close when your loan's coming due, that's, a big key point. And I think that's what helped us really win the deal.
Yeah, 2012 deal in Houston is going to likely have hard money on it in order to kind of get those sellers to want to award it to you. So outside of the asset or the property management company, Asset Living actually helping kind of sell you to the sellers, as if you will, having the ability to put up the hard money was something that allowed you to kind of stand out. What were the other terms of the offer that you had put together as far as like due diligence periods and things like that? I know you mentioned the extension, but talk to us a little bit about the length of that as well.
Yeah, it was pretty standard, honestly. It was 60 day close, 30-30 as far as due diligence. We had one extension, and I think it was kind of it wasn't like a 2-week extension or anything like that. It was like 3.5 weeks. It was kind of odd, but they basically gave us a few extra days to make sure that we could close. And it was really a good thing that we did have the extension too, because we were, we closed, or we got it under contract, I think it was early November. And so our raise was right in the middle of Thanksgiving, Christmas, New Year's. There was election going on and the pandemic. So we had a lot of headwinds, and it was really challenging. And so, we had stuff in there that kind of protected us. We had a COVID provision and stuff like that. We were working with our attorney. We worked with Calliser and Associates here in Dallas, fantastic group. They definitely know what they're doing. So enjoyed working with them, but it was definitely a challenge just because we had a number of headwinds kind of against us at that time.
So on this particular one, how much hard money did you have to put up? And was it hard day one, or was there also additional hard money that had to be put up, or that went hard for the EMD money on after the due diligence period after 30 days?
Yeah, good question. We did 300,000 total. We did 200 hard day one with an additional 100 hard after the due diligence period. So 300 total. And I think they really wanted about 1%. And so that was right there.
So did you put the full 300 up day one and then only 200 of it was hard day one? Or did you only put 200 up day one and then after the DD, you put up another 100?
Yeah, exactly. It was 200 day one and then another 100, down 30 days down the road. Okay. So it wasn't all 300 at once.
Okay. So talk to me a little bit about this property. I know you mentioned it being 2012. What's kind of the business plan for you guys on this particular property?
Yeah, good question. I'll give you a little bit of background on kind of why we started looking at newer too, because, Dustin, previous to this and everything that we'd really been underwriting was all kind of 60s, 70s, C and B class types of deals. But the environment was really important to why we shifted our focus to a newer deal too, because it's not what we had always been looking at. We wanted to mitigate risk however we possibly could. And the property is a big aspect of that. You can really, you got your property and you got your tenant base. And so we wanted to mitigate risk however we possibly could. And if we can, buy a newer property that has less deferred maintenance, it's got newer mechanical systems, you're not having to deal with chillers or anything like that. That was really appealing to us just because, like I said, again, there was a lot of unknowns in the marketplace and we wanted to buy something that could withstand additional, bumps in the road. And so that's really why we settled on looking at newer stuff. And also we were getting, better deals. We were expecting pricing discounts on the older stuff throughout the pandemic because we were very active. We kept underwriting, we kept talking to brokers and lenders because we were expecting, hey, where's the opportunity going to be? But there was no sort of real pricing discount on older stuff. All the cap rates stayed very compressed. And so when you're essentially getting the same cap rate for an A, B, or C, it just made a lot of sense to buy newer. And so that's when we started looking at the newer stuff. And, I think a lot of people think when they think newer, they don't really think value add, but it's very property and market specific. And as soon as we started digging into the deal, we started to see a lot of opportunity here because, it was kind of a first gen value add. Nobody had touched it since it was built in 2012. There was one group that had bought it in 2014 from the developer, but it was brand new when they bought it. So they didn't need to put any money into it. So fast forward a few years and the interiors are a little dated, needs a little work. And the competitors were quite a bit higher because there was newer properties around us. So our competitors were $100 to $300 a unit higher and their finish outs weren't that much better. And, on top of that, none of the competitors were running concessions. So that showed us, hey, we got a strong sub-market here. And, we got an opportunity to come in and do that first gen value add. And on top of that, we're getting the same cap rate that we would if we were to buy a 1970s deal. We bought this at a 5 cap and, I've seen B and C class properties trading at sub 5 caps. So we really like that. It just seemed to make a lot of sense. I do think we kind of snuck in there in kind of a window of opportunity where the cap rates hadn't quite adjusted for the drop in interest rates too. So I think timing did play a lot. And on top of that, like I mentioned earlier, the competition was kind of spread out. So I think there was kind of a lot of factors that were at play that enabled us to get this deal.
So you bought this deal from the group that bought it in 2014 from the developer?
Correct.
Okay. And so they were kind of in that process of making a decision of, are they going to just sell it at this point, or are they going to just refinance it and hold on to it for a few more years, kind of because they were kind of up against the clock there?
Yeah, exactly. I mean, this is the first deal that they actually traded. We bought it from a company called Sync Residential. They got about 10,000 doors in a very short amount of time, about 6 or 7 years. And this is the first deal that they'd actually full cycled. And, they're in a few different markets too. So there could have been a number of factors behind their decision. Maybe they saw opportunity elsewhere. You never really know. But yeah, they had that decision. Do we want to, refi and continue to hold this deal, or do we want to cash in on all the equity that we have built up and move on to the next one? Because, like I said, the interiors and stuff were starting to get dated. So it did need some capital injected into it.
So talk to us a little bit about what your capital plan is for this property.
Yeah, good question. Like I said, the biggest difference between us and the competitors right now is the interiors. They're just a little dated, but the great thing about it is the bones are really great. The paint on the wall is kind of dated. It's just like this yellowish tan. It's really not a good color. The crown molding and the baseboards and the walls are all the same color. It's just one tone. The floors are dated, black appliances and stuff like that. So the great thing is it's a pretty light value add, but the delta between us and our competitors really isn't that much. So the plan is to come through and really spruce up the interior units with, two-tone paint, maybe stainless steel appliances, a backsplash and some new floors, and really see what we can get. We're going to test as we go. We're actually testing a unit right now because we had a tenant move out and left a unit in pretty rough shape. But that allows us to really test some of these upgrades and see what kind of premiums we can get. If we don't have to spend the money, we're not going to. So we want to update it and see kind of what the market can support. In addition to that, we're coming through and we're going to update the leasing center, the clubhouse, the gym, and there's kind of a amenity kind of area for tenants to hang out. We're going to improve all of that, working with an interior designer right now. And then as far as exterior goes, the exterior is in fantastic shape, but there's this big, central courtyard that's really underutilized. It's essentially just a patch of grass. And it's this incredible space. So we're working with a designer here out of Dallas too. We actually just got our first render of what it's going to look like. And it's going to be broken up into multiple different spaces for tenants to use. We'll have a grilling station, we'll have a dog park. We're going to have like hammock areas under trees, and it should be a really cool space because it's very underutilized right now, and should be able to transform that. So that's kind of the main attention. We're rebranding the property as well, and so that's kind of where the money is going to be devoted.
So on the interior of the units, what's the allocation per unit?
It depends on the size of the floor plan. We've devoted about $900,000 to that. And like I said, if we don't have to spend it, we're not going to. But the total budget's about $5,200 per unit, but that's obviously broken up between interiors and exteriors. And we're kind of going to test as we go and see, how much we need. 900,000 divided by 228 is about $4,000 a unit, but obviously smaller floor plans don't need as much. Bigger floor plans like 2 and 2s, and our 3 and 2s are huge. They're 1,500 square foot. So it'll kind of depend on the floor plan and size of unit and stuff like that. But we've got an in-house general contractor here that I office with actually that can knock projects out really quick and put scopes together and all sorts of stuff like that.
So what are some of the issues that maybe came up during your due diligence process on this one?
Honestly, we really didn't have hardly any. Due diligence went extremely smooth. Working with Asset Living was really fantastic. They're an extremely professional group. Lease audit went extremely smooth. I get one of the biggest challenges, especially last year, was being able to get into units to actually check the condition. And so, thankfully we were able to get into 90% of the units. I heard some complexes, just talking with Asset Living, some complexes, they were only able to get into, 30, 40% of the units. And, that's a bigger question mark, what you're going to actually get into when you take over the deal. But, we were able to get into almost all the units. All our systems and everything looked fantastic. There was only a couple minor issues. With the gates weren't closing fully, and we had a couple potholes in the parking lot. And then, we had some irrigation issues, but that's kind of it. I mean, it was really, again, kind of a byproduct of buying newer. You're just buying a better build. And you're also buying, just a newer property, newer systems. And I think the due diligence process was really a reflection of that, because it was pretty smooth.
Well, I will definitely agree with their sentiments around buying newer, which is why our group about a year and a half ago made that pivot. And that's what we've been buying, is the higher end kind of B plus with value add, as well as kind of your core plus properties in the Class A, more suburban Class A than your typical traditional. Maybe you might think of more like an urban downtown infill Class A. So, kudos to you guys for making that switch and transitioning over. I know it's been very beneficial for us as well as our investors. Talk to us about the financing on this one.
Sure. We worked with Berkadia. Those guys are fantastic. Really loved working with them. We went with a Freddie Mac floating rate debt. We got about 76% LTV. The big challenge too with the financing we're still dealing with right now is the additional COVID reserves that lenders are requiring. Thankfully, we didn't need some of those dollars right away. So a lot of those dollars, once they get freed up, will continue. That's kind of like our phase 2 of our value add. But we got really great rate. We got a 50 basis points interest rate cap when prices were pretty much at their lowest they've ever been for caps. So our all-in rate was, I think, 2.93%. We got 5 years of IO. So pretty happy with the debt. And the floating rate also gives us exit flexibility too, with the 1% prepayment. So I know a lot of people are kind of stuck right now because when the interest rates dropped, their prepayment penalty went through the roof. And so we just wanted to have an easy exit, because again, we got it at a really good basis. We got it at $128,000 a door for a 2012 property in a great submarket in Northeast Houston. So the likelihood of somebody coming along and wanting to pay us a lot of money for the property, we thought was pretty high. And so we wanted to have exit flexibility too.
I think that's been great. How much COVID reserve did they require you to pay?
It was 9 months. So it was about $900,000.
And was that reserves. 9 months of P&I or just the interest only period?
P&I. Yeah.
Okay. Yeah. They actually, Freddie Mac just came out and changed their rules. I don't know if you saw that, but they just did. I think it was just yesterday I saw an article that came out about it, and they just eliminated, if you have more than 2 years of IO, they will only require you to put up IO whenever they have 6 or 9 months or whatever. And then depending on the LTV, if it's below 70% in the 60% range, then they won't require any COVID reserve. But if it's still above that, depending on the quality of the asset and where it's located, things like that, it could go down to like, say, 3 to 6 months, which is pretty nice to see.
Yeah, that's really great.
I think we're going to start to see more lenders go in that direction, because the competition with lenders right now, especially on the bridge market right now, is very, very high. It's come back really like with a vengeance, and there's a lot of competition, and they're all competing. And that's one of the things people are going to go after is, are you going to require the COVID reserve? So I know there's one of the very first assets that we had to do that on was one that we weren't planning to do that on, but thankfully we had, we always have plenty in operating reserves. So we had more than enough to be able to cover it. But it was a deal that we did in March. We got it under contract in March of last year. And then, of course, the end of March, what happened with COVID. And then we ended up closing it on time in May of 2020. But we were probably one of the very first properties that had to put up the COVID reserve. And, we're hoping to get it back here shortly so that we can have some extra operating reserves in the property.
Yeah, I know exactly what it was like back then, because we actually had an LOI accepted in early March too, and then the whole world shut down. So it was a wild time, that's for sure. So kudos to you for getting it done. That was a challenging time for sure.
It was definitely one of the hardest deals I've ever had to raise money for because of the amount of communication and the education that we had to continue to do with our investors along the way about collections. And every asset that we acquire, when we do our lease audit, we do a demographic study. So we know exactly the breakdown of the resident, the residents are actually at the property to be able to let us know what's the risk that could be there for, things like this happening and stuff like that. So it definitely helped us kind of sharpen our tools and be able to educate our investors, but it definitely was one of the hardest ones, but thankfully we were still able to close it on time. So we didn't have to extend it all. But it took us it took us 59 days to raise the 19.4 million that we needed to acquire that deal. Cause it was actually I want to say that was a just under $50 million acquisition. It was a $49.95 million acquisition, but we have a great, network of investors that allowed us to get that one through the finish line and continue to close more deals. In Q4 of last year, we closed 3 deals. Like you said, Q3, Q4 of 2020 really was the year, the time of that year that deals flow really started to pick up, and you started to get some deals that you could potentially look at. And competition was still there, but it was spread out across more properties. So it reduced the ability for us to have to, have as much competition on each one of our assets, which is, one of the problems we're seeing now. Like right now, the supply out there has not been as great. And so there's more people looking at smaller numbers of deals. And so those deals tend to have some compressing cap rates, and it's harder and harder right now to make deals pencil.
Yeah, absolutely. I mean, we've offered on a handful of deals already, and all of them have 30, 40 offers on them. And the price from the original guidance is going through the roof. And, it's just like you said, it's tough to get anything to pencil for sure.
How did you structure this deal with your investors?
We did a 7-pref, 70-30 split. We kind of shift, just doing a 7-pref essentially shifts some of the cash flow from the sale to the, cash flow during the hold period. And we figured that that's really what investors would want, especially during times of uncertainty. So we wanted to give them a stable deal with stable cash flow that they could really, rely on. And, we plan to pay out monthly as well too. So our thought process was, investors would find a lot of comfort in that, and that's kind of what they would want during these times. So that's kind of how we structured it, and we're planning to start kicking off distributions here within the next month or two. So super excited for that. But yeah, it's a great cash flowing deal. Our year one pro forma was just over 7% and cash on cash distributions. And we gave ourselves, we had really conservative underwriting too. We give ourselves a 2.5 to 3 year window to essentially raise the effective rents to market. So it's a really gentle push. And we're hoping to be able to exceed those expectations too. I mean, over 5 years, we're only projecting to raise rents 7%, which is a really, really light push, especially since we have a value add component to it as well. So we're hoping, obviously we want to under promise and over deliver. That's kind of the goal. But that's kind of how we structured it, 7-pref, 70-30, strong, stable cash flow, paying out monthly.
And how much money did you end up having to raise on this one?
It's about 10.2 million. So
10.2.
Yeah.
And what was the minimum investment?
We started at a $75,000 minimum. Yeah, at the beginning, and then towards the end, obviously friends and family, and we wanted to let some people in. So we lowered the minimum to $50K as we were kind of wrapping up the raise. But had some big checks. Had some people all the way up to 250,000. I think when we look back in hindsight, because we were, like I said earlier, we were looking at 2 deals, one value add, one cash flow deal. We were very glad we went with the cash flow deal because I think the raise would have been a lot more challenging with a heavy lift value add. So, but yeah, we had, a lot of investors, a lot of good people that, especially Dustin had worked with before, and we've been cultivating relationships for a long time. So excited to be able to get them in, and looking forward to hopefully getting some more.
So how many investors did you end up having in this one?
We had 102 total. So, quite a few investors, that's for sure. But
Well, that's the nice thing about software these days is that, it seems like a lot of investors, but thankfully we have software that can manage with the portal and the communications and having transparency and stuff like that. So it makes it a lot easier when you're trying to communicate with 102 different investors.
Absolutely. Yeah. We work with Syndication Pro. We're big fans of them, and communication on their part was just fantastic. That was why we really liked them too, because we had looked at a number of different portals, and they were very responsive. If we ever had an issue, within 24 hours it was fixed. So very, very big fans of them. Can't really speak enough of them. Great group of guys, and yeah, it definitely helped. This was our first time, obviously I had ever worked with a portal, but also Dustin too. So there was a bit of a learning curve there, but it's pretty intuitive and it's pretty easy to figure out.
So can you think of anything else that maybe happened on this property, good or bad, that we have not talked about yet that might be beneficial for us to talk about?
That's pretty much it. For the property specific, for us as a group, we're looking to hopefully get a couple more, very similar properties. We like this first gen value add play, especially with the time being, because there is, a significant value add, and you get this great property. It gives you exit flexibility down the road. 5 years from now, you could sell it, or you could, hold it. And, in this case, you've got a 13-year-old property, and it's still practically new. So we really, really like this kind of first gen value add, early 2000s, mid 2000s build. That's kind of what we're looking for. The Henry is our brand for Houston that we're looking to kind of stamp on a lot of properties, and kind of get known in that market. Again, goes back to marketing and branding. We want people to know our brand, and we kind of want to, we want to make that a reputable brand in Houston, especially. So looking to get a few more. Hopefully we can get a few more this year. And, the goal is to do a deal a quarter. So we're really focused on the, first gen value adds, looking to hopefully get some more.
So I have two final questions for you as we wrap up the podcast episode today. First question is, what did you find was maybe a little bit easier during this entire process that maybe originally you thought was going to be a little bit more challenging?
Definitely the due diligence process. It was definitely a lot easier than I had anticipated. I think largely because of just the vintage. For a long time we were looking, like I said earlier, at B and C class properties, and you'd find just walking them, you could visibly see all these issues that would have to be addressed. Not to mention what you'd find once you do a lease audit and stuff like that. But I think just a byproduct of buying a newer property, the due diligence process was extremely smooth. Working with a professional group like Asset Living made it even easier. And so I was very, very surprised at, how smooth all that went. Definitely anticipated more bumps in the road, but, thankfully we've got a lot of people. We kind of laid our foundation with great people around us, and I think that definitely paid off.
So final question is kind of the opposite of that one of, what did you find out that was maybe harder than originally expected?
Definitely raising the money for sure. Just because, like I said, there's so many headwinds. We had, a global pandemic going on. We had to raise through Thanksgiving, Christmas, New Year's. There was an election. And on top of that, the floodgates of deal flow just opened. And so everybody had a deal all at once. And so, you're raising, and so are 30 other people. And that was extremely challenging. Just getting people to read their emails and stuff like that during the holidays, that was challenging. But thankfully, Dustin and I, we work extremely well together. And I think that really showed off, and we're willing to pivot and adapt. We didn't sit still, because I think if we sat still, this deal might not have gone through. But, we were up on the phone from 8 a.m. till 8 at night, all day, every day, trying to figure out how to make it happen. How do we need to pivot? How do we need to change our approach to communicate with investors and stuff like that? Because it was challenging, I'm not going to lie, because it was my first deal, but also on top of that, it was Dustin's largest deal too. So I'd be lying if I said we weren't nervous, but, thankfully we've got a great group around us. And, we've always told each other, if we're going to bet on anybody, let's bet on us. And, we just put our heads down and figured it out.
Well, Hayden, how can somebody reach out to you if they have further questions for you about this particular acquisition, or maybe they want to join you on some of your future opportunities?
Sure, absolutely. You can reach out to me directly at Hayden, which is Hayden at momentummultifamily.com. That's my email. Happy to answer any questions. And then our website is just momentummultifamily.com. We got a button at the top that says investors. You can join our portal, see any future opportunities, also learn more about what we've got going on.
Awesome. Well, thank you so much for taking some time here, Hayden, and talking to us about this acquisition. Looking forward to continuing to follow you as you close more deals here in 2021, and then looking forward to having you on another future episode as well.
Absolutely. Looking forward to it, Dan. Always a pleasure.
Thank you.